All right, let's start off. After a historic rally on Wall Street yesterday, what is your word of the day today?
My word of the day, week, month, and the year is fortitude, because that's what we need to navigate this headline-driven market.
Okay, well, easy answer right there. So it sounds like you got a lot of fortitude. I want to ask you about your pick for us today. Your pick for us today is Microsoft. We just had Dan Ives, noted bull when it comes to tech. He actually reduced his price target on Microsoft from 550 down to 475 and said tech spending in general is going to be reduced anywhere from 10 to 15%. Are you keeping your fortitude on Microsoft and some of the risk in that name?
We definitely are, and we would take a measured approach, so it's not an all-in kind of an approach. We take a dollar cost averaging approach to building positions, but Microsoft is one where we have a long-term conviction in the fundamentals. We think AI is here to stay. Microsoft is one of those companies that benefits both on the revenue side, being able to monetize AI to generate more revenue, but also cost reductions because of their huge distribution on cloud and Microsoft 365. Now, what has changed, Frank, is that the stock from its highs in July of 2024 has derated almost 30%, from a PE of 35 to about 27, 28. Can it go lower? Of course it can. And we're not going to know for sure, but that's where we would leg into the position. You know, if you've been sitting on the sidelines, this is where we have a long-term conviction.
Oh, you have a lot of long-term conviction there. I want to tell you about an economic report coming up later today. This used to be the biggest thing in the world. It doesn't seem like it has the same weight, at least not this morning. We have CPI coming up later today. Estimates have it declining. How important is the CPI picture, the inflation picture, when you're looking at your portfolio?
The trend is towards higher inflation expectations, right? So, you know, the Michigan consumer inflation expectations came up where forward inflation expectations are around 5% for consumers. That's at a high level. But again, you know, a lot of that is not related to monetary policy. It's one of these tariff shocks. We don't really know how it shows up until it shows up. And that's why there's a lot of wait and see. And it's difficult to anticipate the reaction to what the CPI is going to be ahead of that, only to risk getting whipsawed.
So you're still seeing some risk of getting whipsawed right now. One area that we've seen a lot of movement in, I don't know if it's quite whipsaw, but the bond market. Just very quickly, what's your take on the bond market? Is it attractive, short end, long end?
The long end, our general approach is anywhere when you see 10-year going above 4.5%, it's a good indicator of forward 5-year returns. So a 10-year long end to us, especially, well, we would say intermediate term, you know, anywhere from 5 to 10 years, we feel comfortable there. If we think 4.5% 10-year is a normalized range for the 10-year, which we think it is, then on that metric, the lower end is definitely, you know, needs to come down.